Hi, my name is Stefan and I'm with the company Trading Stars. The company Trading Stars is active in education of trading as well as in providing trading signals in order to follow our strategies directly. Today, I would like to talk about the Forex range breakout strategy, which is quite interesting, I believe. The interesting here is that not the range breakout itself, but the way how we deal with range breakouts and how we come to our optimized results. But you will see in a few slides. So the basic underlying idea is quite simple and well known for any kind of range breakout. In this case, you have an example of the Japanese euro, just as a short and brief example. If you look to the chart, then you find a gray box. This box is a range, and the box is simply derived by two timelines. One is at midnight and the other one is at 8 o'clock in the morning. And of course, we can see a range price-wise, which is indicated by the gray box as well. When it comes now to 8 o'clock, then we place two orders, one long order, a stop by order on the upper limit of the range, and a sell stop order on the lower boundary of that range. In this case, after a few minutes, it's about 1 hour later, the short order would have been entered, which immediately means that we cancel the long order on the opposite side. And after a while, we have reached the take profit. In this case, we have a risk reward ratio of simple 1. Therefore, that means that take profit is exactly the width of the box away from the entry level. So this is a classical breakout strategy, and the orders are OCO, one cancels the other, and if one order is activated, the other one is cancelled. So if you look from a more distant view to that kind of strategy, you can find that this strategy has 4 parameters. Of course, we have a start time for the range and an end time for that range. In this case of the chart, we have midnight and 8 o'clock. Then, of course, we need take profit range multiplier, which in this example is simply 1, but you can have 2 or 2.5 or whatever. The stop loss is always the opposite side of the range. We have a 4th parameter here as well, which we call the minimum range. This parameter is quite important as well, because if the range is too small, then it's quite obvious that it's not very easy to have profitable trades, because simply the spread in relation to the range is too high, and therefore we need a minimum range as well. So in total, we have 4 degrees of freedom, and what we need is the optimized results or optimized parameters for that kind of strategy. How do we derive those parameters? And the simple answer is we have self-written C programs, and our approach is quite brute force-like. That means all kind of combinations of start times, end times, take profit multipliers, minimum ranges are taken into account, and we try to find the best one we can get. And what we optimize here is in total 3 parameters. One is that we want to have a maximum slope of the equity curve. Of course, that means high profit. But on the other hand, we want to have a minimum drawdown, because what a strategy which has very high profits but has even higher drawdowns is not a good strategy. And finally, we optimize for a high linearity of the equity curve itself, because that is what traders want to have, a linearity in their equity. In order to avoid over-optimization, we perform something which we call the neighborhood analysis in the parameter space. That means if, for example, we find out that a strategy from 10 to 3 p.m. Would be nice, then we want to have that if we change the entry and the end time slightly, that still the strategy is quite profitable. In this case, for example, if we go from 10 to 9 and from 3 p.m. to 4 p.m., then still the strategy should work. If not, then we know that we have over-optimized our parameters. But finally, what we do here is a quite dynamic approach. That means that we go into the history of a chart, do the optimization, and apply our results for the then following future. I know that's quite difficult to understand this. I have a picture here, and I will shortly switch to the normal view of my presentation because I need to click on the box here. You see the green box, for example, which represents data of, for example, 2 years. Within that 2 years, we do the optimization. We find out what are the best parameters for start time, end time, take profit multiplier, and minimum range. And then we apply those parameters for the then following future, which is in this case the red box. For this red box, we do our trades according to the parameters set by the optimization process, and we record those trades. That means afterwards we shift the box slightly, once again do the optimization, apply the results for the then following future, and so on and so on. Finally, that means that whenever I talk here now of an equity curve, it's always derived in the then following future. So it's not a normal backtest we do here. It's an iterative process which always goes into the then following future. This is quite innovative and very good because we know what would have happened if we have done the strategy already in the history. So it's not a normal backtest. It's always applying the results in the then following future. And finally, we are at the real present time, and we do the same in our live account. How does it look in equity now? So if I go on to the next slide, you can see here results for one Forex pair, and you see the equity curve for the last 7 years or 6 years, and this equity curve now is always the results in the then following future after optimization in the green period. You can see now that our parameters, what you see here on the right hand side, is that we have different different parameters for take profit multiplier, minimum range, and so on. Range start time, range end time, which is in this case minutes after midnight. But you can see that sometimes it is necessary to adapt our parameters to what has happened to the market. So this kind of strategy is always looking to a nearer history and finding the best what we can do now. So we shift our parameters according to the optimization process. This is just one equity curve for one Forex major pair, but we trade this kind of strategy for three major pairs. You can see Euro, US dollar, Japanese yen, and US dollar, Japanese yen as well. So we have a combined equity curve now for the three major Forex pairs, which looks quite good. High linearity, but on the other hand, of course, still there are drawdowns, which is quite normal for any strategy at all. So we enter here for this example with a strategy gaining more than 300 R. R is the risk per trade we apply. So if this would be, for example, 20 euros, you can multiply all the numbers by 20 euros. We have a maximum drawdown of 26 R, and the total profit is approximately 350. This is the real history of the backtest results, the back forward test results for about 6 years now. But this strategy runs already quite a while in a live trading account. And in this live trading account, we have that history. Of course, once again, you can see up and downs, but within the last 1.5 years, we gain nearly 80% on the original account balance of 1,000 euro. So right now we are about at 1,800. A good thing is now to compare this live result with the backtest result, the back forward test result in the long-term period. And you can see that in this slide, all the red lines is the live trading account, and the blue line is the history according to the back forward test. Still, it fits quite well. We have nearly the same slope. We have nearly the same behavior in up and downs. So what has happened in the past is valid in the now real future quite well. So a very well strategy, always adapting to the new market situations by using different times for order entries, different range breakout times, different multipliers. And how we do that is simply with an Excel sheet. This Excel sheet is distributed every 11 trading days for each Forex pair. And all the signals we provide via email as well. With that Excel sheet, you can do the calculation by your own because we have all the parameters in the Excel sheet, and the order are in the yellow part here. Another way to follow that strategy is simply a trade copy system, which we offer as well. And so finally, you have emails or a trade copy system to get those results into your own account. We trade this strategy with a risk per trade of 15 euros. We have in maximum 3 trades per day. Not every day we have 3 trades, simply because sometimes we have no breakout from the original range, or we do not reach the minimum range for the specific Forex pair. So this kind of strategy can be run with Argus FX as well, our partner broker for this strategy. And if you have any questions, don't hesitate and write an email to info@tradingstars.de. You can book the strategy according to that link as well. Or if you want to open an account at Argus, no problem. Just follow the link on the lower end of the slide. I hope you find that strategy quite interesting, especially because of the dynamic behavior, the self-adapting strategy for Forex markets. And of course, the results in the history are promising for the future as well, but as every time, no guarantee for the future. Thanks a lot and bye bye.